Hi guys, today I'm hoping to share my main trade idea during this crisis. With the war in Ukraine, high inflationary environment and impending rate hikes, stocks and crypto have sold off while commodities are finally having their day in the sun. I started rotating to commodities before the war happened and I'm still doing so now. Before we carry on, please remember the financial disclosure. I'm not issuing a buy nor sell recommendation on any asset class, and please remember to do your own research. As Russia's invasion of Ukraine shows no sign of stopping, the rush to commodities and safe haven assets has only intensified. Oil prices were up this morning as the US Secretary of State said the United States and European allies are exploring the ban of the Russian oil imports. After Russia invaded Ukraine, the White House has slapped sanctions on exports of technologies to Russia's refineries. But so far, it has stopped short of targeting Russia's oil and gas exports as the Biden administration weighs the impacts on global oil markets and US energy prices. Commodities such as gold, silver, aluminium, copper, palladium have all had a strong performance over the past week. Powell has also testified that the Fed will raise rates by a quarter point at the central bank's March meeting. Powell said that he expects a series of interest rate increases this year and also hinted that he could support raising rates by larger increments later on if inflation fails to moderate sufficiently to achieve a soft landing in the economy. There are also fears that inflation, further exacerbated by skyrocketing oil prices, can cause a stagflation, a state where economies are experiencing slower growth but high inflation rates. And that brings me to today's main talking point, which is gold. Gold has outperformed in this risk-off and inflationary environment and is finally starting to show its status as a store of value. Last year, high growth and seemingly stable prices led to a surge across all risk-on assets, such as cryptocurrencies. As a result, not only did gold face falling investment demand from investors no longer looking for a hedge, it also faced direct competition in Bitcoin as a store of value. Now with talks about multiple rate hikes, fear in the market, and a sticky inflation situation, gold ETFs have seen massive inflows over the past few weeks, and Goldman has increased its target price on the precious metal to $2,150. Gold has not really gone anywhere for the last 10 years, losing its shine as people pour into the US stock market, which has been on a bull run for the past few years, as well as crypto, which has shot up to dazzling heights over the past 2 years. Now, gold is close to breaching its highs in September 2020, but I think that this is just a beginning of a bull run in gold. In addition, even though Bitcoin has had a few swings up and down lately, I don't think it has achieved the same store of value concept that gold has and remains a risk-on asset for investors. I've heard many interviews from experts, especially from Kitco News, and this is an excellent channel I recommend everyone check out from time to time, and I thought I'd divide a few key insights from these interviews. Experts are saying that this inflation is not going to go away, and not only do we have sticky wage inflation, but also energy inflation on our hands now. In addition, many are arguing that the Fed's hands are tied at the moment, and with geopolitical risks, the Fed may be on the side of keeping rates low, which is even more bullish for gold. One of the biggest determining factors of gold prices are real yields. Prices of gold generally move opposite to the change in real yields because real interest rates represent the opportunity cost to investing in anything other than interest-bearing securities, and gold provides no yield. If real interest rates are rising, that makes the opportunity cost of holding gold much higher and suppressing the price. However, these experts say that even though the Fed is hiking rates, real interest rate is still in deep negative territory. If inflation rates remain in the high single digits and nominal rates remain at low single digits, we're still seeing deeply negative real rates. And even if we're hiking by 150 basis points this year, this is not going to get us into real interest rate territory for a long time, and this forms a supportive base for gold prices. However, with all this geopolitical risk and inflation, why has the movement in gold not been so drastic? Firstly, the physical gold market, mostly driven by India and China, were weak last year. Another reason is the dollar-gold relationship. Traditionally, if the dollar is strong, gold prices are weak, and the dollar has strengthened recently because it is still perceived as a safe asset. There has also been two major headlines out of Russia. Russia's government has tried to make gold purchases tax-free in an effort to encourage people to invest in precious metals rather than foreign currencies, which the state needs for its reserves after the West imposed sanctions. In addition, Russia's central bank is also to start buying gold. which should actually present bullish headwinds for the precious metals. They will start buying gold in the domestic precious metals markets, as Russian producers of gold said that it will be very difficult to sell gold in global exchanges such as New York or London due to sanctions. The Bank of Russia already holds 2,300 tons of gold, which is the 6th largest in the world. Analyst Nikki Shio said that while this is initially viewed as bullish by the market, the purpose of buying it should be to monetize it when required, which could not actually be good news for the precious metals, but we'll have to wait and see. Regardless, I've invested around 50% of my portfolio in gold trusts, as well as shares of gold miners, which I think is a leverage play on gold, as well as silver. And this is because I expect a drawn-out conflict this year, oil prices possibly spiraling out of control because there are talks of oil reaching $200 a barrel, as well as deeply negative real rates. Let me know what you think and how you're investing in this conflict, and see you next time on this channel.